Hello. How are you guys doing? All right, so a little housekeeping. So when you're asking questions or trying to do a discussion, just use the mic. NJ over there is going to pass on the mic, so make sure you just do that so we can get that recorded. Okay, so I'll go ahead and get started. My name is Sid. I work at Dharma. We're building a protocol for borrowing and lending tokens, so we're building debt infrastructure. My talk today, and the session actually is going to be on how debt and liquidity actually fits into Ethereum layer 2 scaling technologies. So yeah, again, Dharma is a protocol for borrowing and lending tokens. We've been live on the Ethereum Mainnet since May of 2018. Since we launched, we've sort of originated and serviced about 150K USD in peer-to-peer loans. We have 3 different awesome businesses that have launched on top of the protocol. 2 of them are relayers on the network, so Blockboard and Quickline, and then there's a loan analytics tool called LoanScan where you can go and visualize all the open sort of loans that have been created on the Ethereum blockchain. So I'm going to go ahead and make this sort of claim here that blockchains gives us the tools to make credit markets more efficient, transparent, and universally accessible. The global sort of debt market cap for debt is over $200 trillion, and it is actually one of the biggest asset classes in traditional finance. But the global sort of tokenized debt market caps are still very small on Ethereum. And Dharma, Maker, and other systems are sort of trying to power this more credit-based system on Ethereum that is more globally accessible, inclusive, and transparent, that allows you to build these debt products that are way more sort of easier to monitor and create. So Dharma as a layer is sort of a middleware that sits on top of Ethereum that allows people to build different types of credit derivatives in debt exchanges and consumer loans or crypto native products that require some function of lending. So I'll just give you a quick overview for those of you who don't know Dharma already. Just walk through exactly what the protocol mechanics look like and give you sort of a quick explanation of how Dharma works, and then we'll dive into the actual topic that we're going to be talking about. So the first step in Dharma is to define an actual term of a debt. And functionally, Dharma is pretty similar to the 0x protocol. How many of you are familiar with 0x? Awesome. Okay. So if, you can think of Dharma as sort of like a 0x for lending. And essentially, we have certain primitives that define the characteristics of what an actual debt or loan is. And to start with, we have a primitive called the terms contract. And the terms contract essentially maps to what a loan template looks like. It defines all the parameters that is associated with a particular debt. So it defines how repayments are done, how repayment should be registered on the blockchain, and what the actual contractual environment looks like for a particular debt asset. So yeah, this kind of maps to a loan template where you have all the blanks, and all the blanks are essentially mapped into the terms contract itself as parameters. So the second step is expressing an interest to actually borrow or lend. And we do this through a primitive called the debt order. And this is essentially a off-chain message or a JSON string that a borrower can essentially specify how much they're looking to borrow, what interest rate they're looking for, how much collateral they're willing to put down, and they sign this message off-chain. And this can be relayed to someone, OTC, or can actually go to a relayer, which I'll get into next. But essentially, this specifies the actual intent to borrow. So we'll walk through a quick example here. So Alice has 100 ETH, and then Bob has 100 DAI. Alice is actually looking to borrow 100 DAI from Bob, and below lives the Dharma smart contracts. So when Alice wants to actually go and borrow, Alice signs a debt order or a request to borrow to Bob and basically says, hey, I want to borrow 100 DAI from you. And I'm willing to sort of put down collateral. So what Bob does is essentially agreeing to that debt order, and Bob submits that debt order to the Dharma smart contracts. In a sense, Bob is actually giving permission to the Dharma smart contracts to transfer the principal from his wallet. So once the debt order is submitted, once the actual signatures are valid, the Dharma smart contracts pulls the funds from Bob's wallet and sends the 100 DAI to Alice. In the same process, Alice, of course, gives a commitment to actually transfer the collateral, so the collateral goes and gets locked up in the Dharma smart contracts in escrow. And to represent the actual loan agreement, the Dharma smart contracts mints a non-fungible token that we call the Dharma debt token, which essentially represents a right to repayments on that particular loan. So Bob essentially is now an owner of this NFT, and then he can go and repackage this NFT and sell it on secondary markets if he wishes to. So that was a step for actually borrowing and lending, just a simple sort of explanation of what the flow looks like. And then how do Alice and Bob actually discover each other? So this is why we sort of have a few keepers in the system. And the most important one are the relayers. It's very similar to, again, the 0x protocol. It's essentially like a decentralized lending marketplace where you have a centralized hosted order book, and then a borrower can go and post a request to borrow, or a lender can go and fill and invest in loans that are available to fill. So I mentioned earlier there were two relayers that have launched on Dharma, and one is Blockboard. It kind of looks like sort of an exchange experience, so you can see all the available loan requests, the term, the duration for that particular loan, and you can see also the interest rates associated with it. And the second sort of keeper in the system is the underwriter. And the underwriter is sort of a catch-all term for an entity that does sort of the risk rating associated with each debt asset. So they're responsible for sort of like, checking the credit worthiness of borrower and then making attestations on chain that helps sort of lenders and other relayers to know exactly what the risk associated with each asset is. We currently don't have any live underwriters in the network, but there are a lot of teams that are working on building underwriters for different classes of debt in the Dharma network. So in the instance where you have an underwriter, essentially Alice would go to underwriter, and then whatever magical tools that the underwriter possesses, they can use to essentially, risk assess Alice's creditworthiness and then post that on-chain attestation to a relayer, and then a lender would be able to actually see what the risk associated with it and then invest in it. All right, so now to the more sort of interesting topic. I hope that was a good sort of high-level overview for you guys on Dharma. Do you have any questions so far on how Dharma works? Yeah. What's the fee payment? Yeah, correct. So there is no underlying fee for using the network. So the relayers or underwriters who are essentially originating loans or helping sort of discover loans will be charging a fee. Correct. It's in the order itself. You can specify the relayer fee and the underwriter fee in the actual loan. Yeah. The counterparty doesn't pay what's my ability to recover, and if it's my mistake, then it's not. That's what the collateral is. Yeah, totally. So the question was if the counterparty, if the borrower doesn't repay the loan and essentially defaults, what is sort of the ability to actually for the lender to recover their loss. So which is why today most borrowers who are getting loans on Dharma, since it's sort of pseudonymous identities, are over collateralizing their loan. So there's a fallback essentially if in case the loan defaults, the lender can seize the collateral. But in the future, as more underwriters come on the network, we'll be able to sort of offer under collateralized loans or even unsecured loans. Okay, so there's a lot of interesting developments happening in sort of scaling Ethereum on layer 2, albeit Plasma or state channels, payment channel networks. I'm sure there's a few of you in the room who are also researching these technologies. So like I mentioned, we have these different types of implementations and different types of frameworks to scale Ethereum. Starting with Plasma, you sort of have this construction where you can build hierarchical blockchains off of sort of different networks where you can scale from one chain to build multiple chains that exist on top of each other. And there are a few companies and projects that are implementing them, and there's different sort of Plasma is one framework of scaling Ethereum, but within Plasma itself there are different constructions with different crypto economic incentives to get it working. There are a few companies and projects that are implementing this right now. So I'll go through a quick asset transfer flow, and then I'll sort of explain where Dharma comes in, and sort of what sort of problems we're trying to help, and where people can start experimenting with research to actually help make this better. So in Plasma, I'm going to look only at the deposit and withdrawal instances. So essentially, when a user wants to use a Plasma sidechain, they're going to have to deposit their assets, deposit their tokens from the main chain to a Plasma smart contract, and then they specify whichever sidechain they want to use. And then once the actual funds have been transferred, the Plasma chain sends sort of the funds on the actual sidechain. The user who lives on the sidechain will be able to receive those tokens, and then they can transact and use it however they wish. And in the case of a actual withdrawal, so say if a user wants to move their funds from a sidechain to an actual main chain, he or she is going to need to actually submit a withdrawal request. And the actual in the Plasma construction, there is sort of a challenge period to make sure that there's no fraudulent withdrawal. So there's a thawing period that exists for about 7 to 14 days in most implementations, where users have to wait and bond their tokens on the main chain before they can actually withdraw it successfully. And this challenge period exists because there is a possibility for someone to double spend their UTXOs on a sidechain, or do fraudulent activity, which is hard to actually monitor instantly without actually seeing the network and then validating it before. So this challenge period exists for a crypto economic reason, but it's not really a great user experience if you're someone wanting to have to wait for 7 to 14 days. That's a lot of psychological costs, and it's a really poor user experience. And then moving on to sort of a different framework of scaling, you have state channels as another way of, or payment channels too, as another way of actually scaling Ethereum. And there's a lot of interesting developments there. And one specific scenario that we've been particularly interested in researching is the case where you have payment hubs that essentially aggregate a number of set of channels, a number of payment channels that makes it easy for different users to connect in sort of a bigger topography of the network. So there's a few projects that we're particularly interested in sort of collaborating with that actually helps users actually get a better user experience, and payment hub operators to actually minimize their collateral requirements when operating one of these different networks. So these are two projects that are pretty relevant to what I'm going to be talking about. So yeah, so there's a lot of scaling solutions, but like I mentioned, there's serious UX flaws that we noticed. So researchers and implementers of these different solutions sort of have to start thinking about what are the best ways to provide a better user experience that doesn't require a user to have to wait 7 to 14 days, or put up lock up heavy amounts of capital in order to operate one of these entities. So I went through these already, but essentially these are sort of the two core problems that we see where Dharma could be applicable. So the dense solution Plasma, there are three sort of different ways to do this, and of course with different trade-offs essentially. And of course this is still very early in research, and Plasma is still being implemented. There's different frameworks to do so, and the actual research for where Dharma fits in is still pretty early, and it's something that's ongoing that you can be involved in if you're interested. So the trustless aspect of it, essentially the user who's actually trying to exit from a Plasma chain, who's initiating a withdrawal, can bond their tokens, and a lender who's actually willing to fund that particular user can operate a node on the Plasma chain and watch all the transactions to make sure that the actual exit for that particular withdrawal is valid. And this could be done trustlessly if the lender is able to actually monitor the entire chain, and then they can actually sort of believe that that's the right history, and they can front the user money. And sort of after a week or so, when the actual tokens are released, the actual user who's getting the loan can repay it. And of course, there's definitely an interest or risk associated with it. So the lender or the actual user who's withdrawing can be sort of risk assessed based on their past history of withdrawals. And then sort of the semi-trusted or crypto-economic incentive case is where a lender relies on a third party. So if you're a lender looking to sort of front capital for users who are trying to withdraw, maybe there's underwriters or there's like third-party attesters who are essentially operators or watchers on the network of a plasma chain who attest to the risk of that particular withdrawal, and then you sort of go based on their, you go off based on their attestation, and then you can like sort of lend to that. And in this case, the underwriter or the actual risk attester can put up a bond or have some crypto-economic incentives to make sure that the lender is compensated if in case this actual thing is defaulted. And then there's a fully trusted case where the lender assumes the full risk, but of course they have to trust the plasma operator, the watchers, and the other users. And this is the case that we think mostly fast withdrawals in plasma will start with, just because it provides a more easy on-ramp to start centralized and provide an entity that can easily do this. And this is more sort of like a crypto-native debt use case that we're particularly interested in, that's like pretty relevant to what we're building as a protocol. And so if there's anybody in this room who are interested in like sort of exploring this use case, come talk to me afterwards. We're really happy to discuss this in particular. So this is, so there is an actual project that is implementing fast withdrawals using Dharma protocol. And the way they've implemented this is pretty interesting, and they're still sort of in development, and they've not yet sort of finished actual implementation. But the way you would sort of do this is when a user wants to withdraw their tokens from a plasma chain, the actual contract mints a non-fungible token that represents the actual withdrawal. So you can take that NFT or the non-fungible token on the main Ethereum network, and then you can trade it on, say, a decentralized exchange protocol like 0x. You can sell it at a spot price. Or you could take that NFT, use it as collateral for a Dharma loan, and then get your capital. Does that make sense? Okay, cool. So they're actually implementing this today, and we're sort of working with them to make sure that the implementation can be done feasibly. But essentially, one way of generalizing this is to have plasma implementations generate an exit NFT whenever someone wants to withdraw from a side chain to the main chain. And then if you look at payment channels, one construction, at least for payment hub operators, that we've been particularly interested in, and this is still that is most of conceived as an idea. We haven't like really done a lot of research on this. But the way to construct this would be payment hub operators who are fully collateralizing their hubs could issue and sell low-risk bonds off of those actual collaterals that they've placed in the particular channels, and then sort of sell those on the Dharma credit market through relayers and underwriters. And of course, this requires them to have a counterparty, but the interesting nuance is that you can actually monitor the cash flows and the revenue that a hub operator generates from a layer 2 chain. So it would be easier to underwrite and sort of provide capital for these hub operators. And of course, this helps scale these networks if there's more hub operators and helps with decentralization. So with here, I mean, I'm going to let it sort of open here for like questions and discussion. A lot of this is like still under development and active research. So if there's any plasma implementers or researchers in the room, we'd be happy to jam with you guys afterwards too. But are there any questions so far? Any interesting ideas you guys have?
I don't understand if you can scan the plasma nodes and see whether the withdrawal order is valid. Why can't the plasma operator do that and not wait for the summit?
Yeah, so I think a plasma operator is actually well positioned to front. Yeah, so his question was if an operator can run a node and actually check for transactions to see if they're valid or invalid or withdrawals, why can't they actually provide the capital for withdrawals, is that right? Yeah, and that's actually true. So I think they would be one of the best candidates to do so because they're the ones sort of watching the chain actively, and they want to provide a good experience for their users on their chain. So it's in their best incentive to actually provide capital for users who want to withdraw. And just running an operator or running a watcher also involves, capital lockup requirements. There are places where if an operator is fraudulent, they could be slashed. So there's a lot of risk involved with even running sort of an entity that monitors a chain. So, I mean, if they're being honest and they actually want to have more users on the network, that's an additional revenue opportunity for them.
But wouldn't you want to have an alternative in case the operator goes rogue or something like that?
Yeah, absolutely. Yeah, definitely. I think. Yeah, in the Dharma case, that's why I'm saying like someone could run a business specifically just to watch the chain, right? And you can have maybe a decentralized set of operators. And this is where it gets really sci-fi. You can have sort of a network that competes for actually like risk assessing which withdrawals, or testing for different withdrawals. And this could be like a separate underwriter business that can be built, when different Plasma implementations go live.
One follow-up question. So this would probably enable like deeply nested Plasma chains to, if you wanted to jump from layer 3 to the root chain, you'd probably be able to do that in one single step.
Yeah, so his question was if you had sort of different layered Plasma chains, say you had like 3 or 4, what would be the easy way to exit to the main chain the quickest? I don't know. I think there definitely has to be a way to automate the process of paying out all the bonds that you have on each sidechain. So I'm guessing then you will have to have lenders on, or maybe smart contract based lenders on each sidechain, where like when you initiate a withdrawal, there is a underwriter that checks your deposits on all of the actual chains, and then there's automatic lenders that basically deposit the funds to the actual borrower on each sidechain. But of course, I don't know how it would be done atomically. I've thought about how it would be done with one sidechain, but that's a pretty interesting thought experiment. Yeah.
What's the timeline for implementing something on a Plasma chain? Yeah,
so I've been following a few implementations. I don't know off the top of my head exactly when certain implementations go live. The team that's building or integrating Dharma that I mentioned previously, they're hoping to launch a alpha mainnet early next year. So I'd say like 6 months to a year is sort of reasonable to see at least the early versions of mainnet Plasma go live. But of course, for them to gain adoption and get dApps and get users, that's going to take a few years. And then actually having a need to withdraw is going to take 5 to 6 years, at least in my estimate. But I'm not sure.
And maybe a follow-up question.
Yeah.
What do you want to see in terms of assurances before you move some of these loan contracts onto the Plasma chain? What is Dharma looking at?
Like to see when this would make sense to be built. Yeah, I mean, for one, definitely like implementation need to go live first, right? There has to be Plasma chains that are currently live and have active users who are facing the problem of withdrawing, right? There aren't any users that, to our knowledge, are facing this issue today, but this will be an issue once Plasma or state channel implementations go live, and there's going to be heavy capital lockup requirements. And I think like from our standpoint, it's something important for us to consider. And also, interestingly, I think why we're thinking about this now is because we'd like implementers to actually start integrating Dharma from the get-go into the implementation, so they don't have to add it on later. So they can start making the smart contract integrations from the get-go and make it easy from the start. So users don't have to know about the actual challenge periods or any dispute resolution. They can get fast withdrawals from whenever they're actually using a Plasma chain.
Do you know what is the current state of any reputation or credit systems being put on? Because I asked, because without them, you're not going to have collateralized loans.
Absolutely. So yeah, outside of Plasma, outside of sort of layer 2 scaling, yeah, I mean, reputation and identity systems, to our knowledge, I mean, we're still researching them. They're not anything that's live that can be used today in production, which is why all the loans that are being traded on Dharma today are over collateralized, right? So I think we really need a unique decentralized identity system that's Sybil resistant that you can trust first, start using, and then it's easier to build reputation models off of that. We're still actively researching that. We don't necessarily have a solution for it yet, but it's something that is like very important for credit scoring. And to start with, I think the short to mid-term solution is to start like federated, have the ability to port real-world reputation or real-world like credit scores on chain as a medium, like short to medium-term solution, and then as we're able to build decentralized identities, and there's a lot of teams working on that, we'll be able to build credit scoring models or reputation off of that.
Yeah, you mentioned something in passing just now, and I'd like to know about it more. You mentioned heavy capital requirements as assets move from one side chain to the main chain and then off the main chain back onto a side chain when the plasma system is up and fully operational. That sounds like a very large amount of capital needed, because every one of those transitions will have to be backed by a lender if it's not to wait for 7 days. It's kind of like, I think it's kind of like a debt factory operation.
Yeah.
So if you've got a limited money supply, that could really turn out to be a choke point to economic activity. Do you want to just offer your own thoughts and comments on that, or you clearly had some discussions about it with the team?
Yeah, absolutely. So I think realistically, like the way users are thinking about it is that you would have certain app side chains, you'd have certain plasma chains for certain use cases or certain types of needs, right? But realistically, you only want to withdraw to the main chain when there's actual economic activity there's a utility for you on the main chain. Or if you want to transition from one side chain to another side chain, you need a bridge to go through that. I'm not totally sure if there's any like side chain to side chain bridges yet. Maybe there's other people who might know if someone's researching that. But essentially, like, yeah, there is heavy capital lockup requirements, which is why we're saying that having some debt facilities to cover that capital lockup or providing mechanisms to make that easier on a payment hub operator, for example, could be useful. But for the end user still, like, there's definitely going to be a need for someone to come up with a solution for providing fast withdrawals. Otherwise, I mean, there's going to be limited activity because there's not going to be any reasonable user experience. There's going to be no incentive for them to want to like move across chains, and they're just going to have their capital locked up in a side chain, and then it's going to really tamper with user experience. And there's also there's a lot of other user experience challenges on the main chain itself. But as we're scaling, I think it's very important for us to think about these problems and talk to dApp developers and think through all these from like first principles.
I was wondering, do you know how many users are requesting loans that aren't for margin trading and what those use cases are?
Yeah, so it's hard to like sort of give a number on that today. I think most of the loans, I'd say like a solid like majority, like 90% or so, are definitely speculative on Dharma. So we actually released a recent product called Dharma Lever that you guys can check out. If you're any traders or funds, you can sign up, request an invite. But the use cases that are non-speculative, non-margin, tend to range from people who are, looking to, looking to get, probably like they are closed off from the traditional banking system, or they owe sort of like debt to their friends or something that they're willing to accept crypto, but it's really unclear exactly what those use cases are, or if they're trying to collateralize an NFT to get a loan. And one of the companies that are trying to actually use Dharma today, they're trying to use it for invoice factoring. So Centrifuge is trying to use Dharma for funding, invoices. So this is actually a huge industry that exists today in the traditional finance. So you could be able to, use Dharma as a way to access credit on-chain funding for an invoice as a company. But yeah, today most of the loans on Dharma are over-collateralized, and I'm not sure what the actual other use cases are for people.
Can I add something to that?
Yeah, sure.
So one of the use cases in the States, you can take a loan and it's not taxable. And then so it's a way to, instead of selling it back to dollars, you can, instead of just do it once, you can lose your crypto volatility risk and just go into DAI, let's say. that exposure to.
Yeah, it's more so like a working capital, and it's also has like tax advantages. But most of the crypto loans, I mean, outside of Dharma too, that we've seen are people who are using it for like working capital, where they have crypto assets and they want to gain exposure. They don't want to be able to sell it, so they're getting sort of a stable coin of sorts and then using that for working capital. Any other questions or thoughts on layer 2, scaling, UX? Yeah. If you have a question too, that's fine. Yeah, if it's outside.
Well, I was just curious, you were saying that you had enabled nodes for 140K.
Sorry, can you speak up a little?
That you had said that you have enabled nodes for 140K without the role of the underwriter. And is this because they're over-collateralized?
Yeah, they're mostly all over-collateralized. Yeah. All right, great. Well, thank you so much again. I'll be around, so if you want to talk about any specific things related to Plasma or state channels or like Dharma, come find me. Thanks.